welcome. So we're going to be going over some questions today that were here in the Discord. So the first question is from Kyle. Kyle says, hey Nick, when you're using hedging and you get hedged multiple times in a row, when is it a good idea to just give up and close all of the positions? So Kyle, my answer to this actually comes in a little bit different of an approach than you might think. So I opt to prevent that from happening as much as I can, instead of being in the position where I have to manage that if and when that does happen. Because if you're using hedging regimentedly in a black and white way, yes, that will statistically happen a percentage of the time, and it's very, let's just say, not fun to have to roll out of something like that. So I opt to prevent that from happening, and I'll show you exactly how I do that. So I'm going to share my screen here, and then we'll head to the TradingView charts, and then I will give you an example of whenever I am using hedging as the risk structure, what to do whenever you get invalidated over and over. So we'll start with, we'll say 3 zones. So price has come up to resistance, and then at this first resistance zone, let's say that you would like to sell. So price, it's bounced here, big bounce in the past before, takes a while, then it gets back up to this resistance zone, and you would like to sell right there. So whenever you sell right there at the resistance zone, you are likely going to have the next set of areas mapped out where price is likely to bounce at. So for example, if price doesn't bounce here, it could go to the next zone and bounce there, or the next one and bounce here. Now, of course, not always. It's a 50% chance it'll bounce at one of the zones, but you still think it's going to bounce. So let's say price comes here to this resistance zone and you sell. And then what your plan is if price breaks above this zone, you would like to buy above here to hedge. And then if price gets to the next zone, you would like to close that buy at the next zone. And we'll illustrate that by just drawing this little line from here to here. So your entry would be there for the buy. You can have a buy stop, like a pending order or something. Then you would close it at this zone, and then you would add a sell. And then what would happen if that gets hedged, right? You have to hedge that buy right there with one buy, but then you also have to re-hedge your initial sell with a second buy. So if this first sell was 1 standard lot and this second sell was 1 standard lot, then you could have 2 buys each at 1 standard lot, or you could just put 1 position there at 2 standard lots, whichever way you want to do it, but you will have to hedge both of these. Then price could go to the next zone and all this shit, and it's just wild. So let's take it back. You enter the trade right here, and price breaks above this resistance zone. So you get hedged. So sure enough, price goes to the next zone, and you close the buy right there at that next zone. Then after doing that, you think since it's going to bounce here, you're going to add a sell in an attempt to break even on the likely probability that it'll pull at least halfway in between the zones where you can get out at a loss on that first sell and at a profit on the second sell, leaving you at net break even on the sell outcomes while having had a profit on the buy outcomes. But instead of that happening, price breaks above this next zone again. So you are forced to hedge again somewhere above the zone, and you hedge. We'll illustrate it with 2 positions. So then you get here to this next zone, and then you close both of the buys right there at that zone. Then you add a sell position. So, as luck would have it, which will happen from time to time, price breaks above this 3rd zone. So I think you get the point. A trade just gone really wrong. You get hedged multiple times over and over. Now, you have to hedge 3 times, or at least you have to hedge all of these 3 sell positions. Now you're in what we call a pickle. It's kind of hard to roll out of this. It's still possible. You can still do it. It just generally takes a little bit longer, and you're also going to end up taking a little bit of a loss. Usually, you may be able to come out at break even depending on the specifics, but usually it won't really be a profitable outcome. It'll either be a losing outcome or a break even outcome when it does happen. A lot of times it'll just bounce at the first or second zone, but every now and then you get yourself into a pickle where you have to do this. Here's how I manage this. I opt to manage this by preventing it from ever happening in the first place. And here's how. I'll sell whenever price gets to the first resistance zone. When I'm using hedging as the risk structure, I will hedge if price gets past to the zone. And now we've got a plan to manage the hedge here at the next resistance zone. So on the daily, 4 hour, wherever the next clear resistance zone is. So sure enough, price does in fact push to the next resistance zone. So I will close my buy in profit right there. I will add a sell. Remember, half the time it'll bounce there at the first zone. The other half the time it'll bounce here at the next zone. Your average losing streak will be about one trade because it's 50-50. You'll be right one time, you'll be wrong the next time, right one time, wrong the next time. But you will get into the case where the statistical probability of you taking multiple of the same outcomes in a row, so the same losses in a row, that still happens, and it can happen 2, 3, 4 times in a row. It's just statistics. So let's say price breaks past this zone. Here's where the magic happens. Instead of re-hedging both positions with a buy there and then, a second buy, so each of the sells are hedged, one for the second sell and the second one for the first one. Instead of that, I opt to just close that second entry at a small loss when price breaks above the zone. So I don't hedge the second entry. I just close it at a small loss. And then I will enter a hedge to re-hedge the first position. Let's say price continues and it rips up to the third zone that you have. You really think price is going to bounce here. Well, I'll close the buy right there and profit. I'll add a sell. Now if price can pull all the way back to the middle zone, the second zone that we entered off of, we could still kind of break even on those outcomes. And then plus we've had a profit from the 2 buys that were big, and then we had a tiny loss. So it'll still probably be a profitable outcome. But what if price does in fact go past this zone? I will do what I did at the second entry again. I will close that sell at a small loss, and then I will re-hedge the first one. Now what you'll notice is we're taking little bits of losses here, right? These little losses, we're taking them, we're realizing them. But what it does is it prevents our margin and equity from being tied up in a trade that's gone horribly bad. Because though you may take smaller losses here, the net outcome is more likely to be profitable. Your psychology is likely to be more level and flat to where you're able to make better rational decisions. And on top of that, you don't have a lot of your margin and equity tied up, so it allows you to use that margin and equity for trades that are actually going good instead of spending it trying to roll yourself out of a trade that continues to just break through a bunch of zones. This will mitigate that risk every time. Now let's say finally after the third time, price comes back here, tests this zone and starts bouncing, so you think it's going to bounce. So you're already out of this sell. What you could do is you could just add a buy right here. And then if you add a buy right there, the invalidation for that could be just under this zone. And let's say the entry's up a little bit higher or something. And then if it finally bounces there, well, now you have a winning outcome on 2 trades. And if it gets to the next zone, what you can do is you can just close that buy there. You can close this buy here in profit, delete the pending order for the sell. And at that point, you will have had enough profits from that buy to probably offset these losses, which you had a loss from here to here, 68 pips. You had another about 1 unit of loss here, and then another 1 unit of loss here. And if you finally have a trade that wins for that right there, that's more than triple the amount of whatever the losses were, or that probably is roughly triple. Yeah, because 70 times 3 would be 210. So that's a little under triple of all of these losses. So you can roll out of all those there, plus you're hedged on that first one, so you could just close that by there, and the total net outcome will be a break even. And this is you getting it wrong 1, 2, 3 times in a row before finally an opportunity worked out. So this break and retest worked out right here. So instead of coming out, at a huge loss on this or closing everything accepting a huge loss, we're able to roll out of this at break even. Now it won't work out this way every time. In fact, most cases, whenever this happens to me, I end up coming out at sometimes a break even, but usually it ends up being a loss. Now, it's not a big loss. It's usually not like a huge 20, 30, 40, 50% loss, but it is enough to kind of eat up the past few trades. So sometimes maybe 5 to 10%, sometimes less, in rare cases, sometimes a little bit more. But that will happen because that's just statistical probability. Let me know if this answers your question. And if you would like more clarification on something else, Kyle, I'd be happy to clarify. Just let me know. Andreas says, do we keep positions open over the weekends? Yes, I do, Andres. I'm not logged into my terminal right now here on forex.com, but I do keep positions open over the weekend, provided that they're still far enough from their targets. So, yeah, if this was close to the target, I probably would have closed that on Friday, or if it was close to invalidation or stop. And then Euro USD, same thing. It's still, we've got a lot more potential downside to go, so I have just kept these positions open. It's perfectly fine to keep positions open over the weekend, provided that you're swing trading and provided that price is not super close to either the invalidation or the profit target. If it's close to either one of those, I'll usually just close the position. Ozan says, hello, Nick. I saw your answer in the screenshot below. Could you explain a little bit about the risk management you mentioned in the second paragraph? What do you mean by retain the hedge specifically? Opening the hedge or making it wait? So let's read the second paragraph, and I'll try to give more context to help. I wrote, I'll also add that if the new invalidation for buys at that support level are bigger than what your original invalidation and lot sizing was based on, it might be a better idea to retain the hedge and place a new buy with a bigger inval and a small lot size to control risk. This will make your max exposure only one additional unit of risk. So it looks like pretty much what you're asking. What do you mean by retain the hedge? All that means, Ozan, is to keep the hedge open. And the reason for this is a risk management structure that prevents you from exponentially increasing your risk. And I'll give you an example here. That way we can see it nice and simply. So when price gets to the first zone, let's say that you want to take a sell here at this resistance zone. And so you do. You enter a sell position. And then you have a hedge, let's say, right here. Let's say just above the zone. And the hedge for this distance is about 80 pips. And so for this trade, price breaks past the zone and it comes up here into the next zone. Now let's say this next zone is a big, thick daily or weekly level. And let's say price comes up in here and you would like to somehow manage the hedge. And so you figure out if you're going to structure your trade, if you're going to close the buy and then add a sell right there. For you to want to hedge, you don't want to do it too early. You want it to be kind of like pretty clear past the zone, especially if this has been like a big zone where price is just like reversed in the general area multiple times, but it's not like super clearly defined. So if you want to manage it this way, then what you'll notice is that this distance to that invalidation right there is 75 pips, we'll say. This distance here is roughly double that. It's about 150 pips. So let's say if this was $1,000 risk, if you were to add a sell here at the same lot size and have an invalidation above there, since it's the same lot size as this one, but the invalidation distance is double, you would be risking double on that second trade as you were risking on your first one. Now this is okay if you want to do that. I personally don't do that because I like to keep the stats nice and even. I don't like to go into positions where I'm immediately risking more on an outcome that I think is just as likely to occur. It's a different story if I believe that the outcome is very likely to work out and I have strong conviction that it'll work out. But in those cases, I generally wait on a little bit better of an entry and then I have a tighter inval to represent that increased risk. That way, if I'm right, I'll make a little bit more than whatever it is I lose. But in this case, if you were to close the buy there and profit, and you were to add a sell, and it's the same lot size, you have to accept that if price goes up into this zone, you are adding, along with your first 1 unit of risk here that you have, you are now adding 2 additional units of risk for having that position. But not only 2 additional units of risk for that position, you have a position down here which was already in 75 pips of loss when you hedged. Now you're adding 2 additional units of risk to that position. And so now, while you initially started out at 1 unit of risk, you are now going to assume a total of 4 additional units of risk if price breaks past the zone. So if you had started this trade out nice and simple with a $1,000 risk, what you have now is you are adding $4,000 extra of risk. So that means that if this case plays out where you add your sell and it's the same lot size as the first one and you hedged at your invalidation distance and everything's still the same, that means that your $1,000 risk, if price just goes up a little bit more, this immediately turns into a total of a $5,000 risk, which is 5 times what you originally risked on the first entry. I don't think this is the best way to manage trades whenever there's a bigger invalidation. So, the reason I said it's a better idea to retain the hedge is for this right here. When price gets to this zone, instead of closing the buy and, managing the sell by adding to it, instead of that, I will just keep the hedge open and I'll just look at this right there and I'll just ignore it. And instead, I'll approach this second trade up here as a new trading opportunity. And here's what I'll do. I would enter a sell position, and then I would have the invalidation up here, and then I would calculate a new position size for this. So if this is about 150 pips of risk, I would calculate a new position size. And the position sizing, if I'm risking $1,000 here in the second opportunity, it'll be roughly half the lot size of whatever this one was, because it's double the amount of pip distance, but for the same amount of risk. And what that means is that if this outcome does play out, let's say it bounces right there, then you'll have about a 1-to-1 unit risk reward of profit, that's about 150 pips right there. Then you can just close that sell and profit. You've made $1,000 if that's what you risked. And then you can also close this hedge, so the buy and the sell, you can close it at a loss, and you've lost 1,000 there. So you broke even on the outcome, which is good because you avoided mishap. You broke even on the outcome, even though you were wrong once. You were right the second time. But on top of that, you broke even on the outcome, having only had 1 additional unit of risk. Because if this second trade were to not work out, it's not going to mean you're adding 4 units of additional risk, $4,000. This is only an extra 1,000. Because remember, you didn't do anything with the hedge down here. We retained the hedge. We kept the hedge open. So this is a way of controlling risk in the situations where your second or third entries that you're trying to manage your hedge at, when the invalidations for those trades are going to be much bigger, usually double or more of what the original invalidation was. In those cases, I personally think, I'm of the opinion that I think it's better to keep the original hedge position open and then start a new position with its own dedicated invalidation and its own dedicated lot size. Because if that doesn't work out, it's only 1 more additional unit of risk, and your first position is still hedged, so you're not losing any more on that first hedge. You're just losing on the second position, and it's still structured and controlled. So if that happens, you would only be in a 2-unit risk of net drawdown instead of 5 units of net drawdown. And of course, there's always a likely chance that half the time it just bounces. And if it gets to 150 pips profit, that's $1,000 profit. You can close the sell there. You can delete the buy order. And then you can also close both of these trades in loss. That's a $1,000 hedge loss. But then you offset it by this $1,000 win, and then you broke even on the whole outcome. So it's a good way to always get out of outcomes, roughly always, around like break even or small loss. And that does answer all the questions, Ozan. Thank you for the question. And if you'd like me to clarify, just type your message here in the chat, and I'd be more than happy to help with that. Amazing questions, y'all. We had another great week last week. I'm really looking forward to this next coming week. I'm really enjoying hanging out with you guys in the Zoom sessions and in the Discord and everybody asking questions and learning together. You guys are what makes this community awesome. So I appreciate each and every one of y'all. And I'll see you in the next one. Cheers.